Hello, welcome to the Gain Meets podcast. Today I'm joined by Natalia Tsitoura of Apollo Global. Natalia is a partner in the Apollo Capital Solutions business and is going to help us navigate alternative assets, what they are, investment strategies, and her experience in investing. Welcome, Natalia.
Thank you very much for having me.
Pleasure. So, we're here to talk about and learn about the basics of alternative assets. But before we get into that, I'd like you to give us a whistle stop tour of your career to date and how you landed in your current role, please.
Yeah, very happy to. So I'm a partner in our credit business, responsible for direct origination in Europe. And really, there are three aspects to the job. So first of all, sourcing efforts. My job is to look for attractive companies with good cash flow in stable industries that fit the investment thesis of Apollo, that ultimately require some sort of financing. And this could be as part of a buyout, this could be as part of an acquisition, this could be additional liquidity, or this could be to fund their expansion. Once we find that opportunity, the second part of the job is finding the right product that best serves the needs of that company. So here at Apollo, we have a number of different tools in our toolbox, and we can discuss this in a bit. There isn't a one-fits-all mentality. Loads of different pockets of capital, which they do slightly different things. We have from asset-backed loans to investment-grade credit. And what we try and do is find the best solution that fits the needs of that borrower. So we spend a lot of time with the management teams and the ultimate owner of the business to structure that. And finally, once we do that, then we have to execute that transaction. And that requires various levels of diligence, a number of investment committees that we try and go through in order to ultimately partner with the company and the ultimate owners of the company. So the job is really kind of securing that investment opportunity, but also it's an investment job. So we want to make sure we are good custodians of capital to our investors and our balance sheets by making sure that we do not lose money. So that's ultimately the job.
How did you get into this space?
How did I get there? So I have been at Apollo for 4 years, and previously to that, I was at a very similar job at a smaller fund that really specialized in a sub-segment of that alternative asset class. I started my career straight out of university. And like most, I didn't really know what I wanted to do, but I liked the concept of being an investor. I liked finance. I had some exposure to investment banking, and I thought it was really cool. When I tried to figure out what it is all about, it felt like it was packaging different deals, cool deals, putting it all together. And these other people over here were, called investors would invest in it. And then when I thought about it, I was like, that's actually what I want to be doing. I want to be the one picking which is the right investment. And I was lucky. 17 years ago, I joined a boutique firm that was pretty flat. It was a pretty flat organization, very hands-on. And it's such a cliche, but it was an amazing learning experience. Every day was a very steep learning curve. And once I spent 2-3 years doing this, I kind of felt like I had the basics of the job, and I was loving it. I was trying to, I was getting better at the modeling bit. I was getting better at all the jargon and understanding what being an investor is. And then the GFC happened. And that was possibly the best career gift anybody could give me. It really did not feel like it at the time. So maybe there's a lesson in that you should always embrace, the challenges that come your way, because the benefit of hindsight is great, but you can learn a huge amount from all of that. So after a long period of no defaults and a very benign economic environment, which frankly, the only thing we were debating is how fast the business would be growing, then there were a lot of defaults. There were liquidity crises. There were very, very steep declines. And it was an amazing experience. I sat on boards, I restructured businesses, and it was fun. It was ugly. It was challenging, and it really did shape me as an investor. It really, I think these kind of periods really do shape you. I think it tests the relationships that you have in place, and it also keeps you humble, because you start doing it for a little while. You're saying, okay, I've got this, like it's fine, and then the whole market, everything you know about it, just changes around you. So one of the that was a fascinating experience. But one of the effects of the GFC is that a lot of the banks were shrinking their balance sheets, and they were not lending to the same extent they were lending before. And that gave rise to this kind of private debt industry. It really started flourishing over the last decade, and then became a much bigger part of this alternative space. And that's where I'm spending the majority of my time now, on originating these kind of private loans that backing corporates or different assets, and then we raise loads of funds and then deploy those funds, and then the rest is history.
So can you talk about, upon entering the alternative space, what your perception of alternatives was versus what the reality of it is?
Yeah, so it didn't really have that title. So I thought of it as private equity and private debt. So maybe taking a step back on what actually is an alternative.
Correct.
We define it as an alternative to publicly traded stock and bonds. The different asset class within that, we think of it as private equity, private debt, and then hybrid is the bit in the middle that sits, and that could be a mix of debt or equity. It could be either or. And each one has different risk and reward profile. Obviously, the most risky being equity. Typically, you sit on the bottom of a levered capital structure, and there are different parts of the credit spectrum that from the safest to the more risky ones. So the alternative space is something that investors look for excess return at every point of that risk spectrum. It has been an amazing journey because, as you say, when I first entered the industry 17 years ago, it really was private equity and private debt. So private equity, it's basically asset managers where they would buy a business. They would make a number of operational improvements. They would look to grow earnings, and then they would sell the business in 3, 4, 5 years' time, when earnings would hopefully be higher, and so would valuation. And the exit could be an exit to another private equity group, a strategic buyer, or it could be a listing. And to some extent, private debt, which is the area I'm involved in, it is a byproduct of this industry. It used to be heavily linked to M&A volumes, and obviously the private equity industry itself, because you help finance those companies, and that's how the industry started. And it has been fascinating towards the journey. Today, the definition of alternatives is so much more, and certainly when I started in the industry, I had no idea there were all the different aspects of alternatives. And we think about this kind of risk-reward universe. You've got, from one side, something like an asset-based loan. So that's basically everything that you touch in your day-to-day life. That's your home, that's your car, that's your gym membership, that's the music you listen to, that's planes. And so financing linked to that is a massive industry, and one that we're heavily involved in here. And then from the other side, you've got cash flow loans that you can put cash flow loans to some of the largest investment grade companies, which again is really unheard of. in the alternative space. So you can create private investment grade product. And that is a huge area of growth. And we think when you put all these different pockets together, that's a 40 trillion opportunity that we're very excited about. Apollo is one of the largest alternative managers, but certainly the definition has evolved massively since I have been in the industry.
So you talk about private debt, and today it's a real buzzword, right? People are talking about private debt a lot, more than I've ever heard in my career. What do you think makes it so appealing, and do you think it's an area that's going to continue to grow?
Yeah, so we have been to some extent victims of our own success. So last year, especially given the markets were, in a very different shape to what they are today, every single headline you'd be seeing would be talking about the golden era of credit. Now, it goes to show how fast the markets move. Now, if you look at the headlines, it's no longer the golden era of credit. I mean, golden private credit, the way we define it, which is all the different subsectors that we're describing, will absolutely continue to grow. But I think a lot of people just think of it as private debt providing financing to private equity-backed companies, and there can be times that that slow down if the M&A is slow, or if the capital markets from especially from where the banks participate a lot are particularly buoyant. So that's why the way we look at private debt excites us a lot more, because you're not just reliant on this part over here, which is very linked to ultimately what the health of them and M&A markets are going to be. We are very excited about the growth of private credit, and we do think it will continue to grow. The way I described it previously in terms of creating that alpha, creating that excess return at every point of the cycle, we think that that's how our investors are thinking about it, and they're asking for more and more allocation to alternatives. But that's not just cash flow. That can be asset-based, that can be investment grade. The market is just huge. And we're very humble in the industry. We are one of the largest. If we just touch and scrape the bottom of that, 40 trillion industry, that's just a huge market to, really try and navigate through and do a lot of deals. So I do think the market has become a lot more mature, and our job as a result has become a lot of fun, because you're not just boxing in what the attractive opportunity is going to be like, which historically was that leverage buyout backed by private equity. Actually, my job today is so much more diverse. One day I speak to a CFO of a publicly listed company. The next day I speak to a management team on an investment grade issuer. The other day I'm speaking to a private equity group. The other day I'm speaking to an infrastructure fund. So when you put all this together, it just creates great diversity, and it's what keeps me going.
Do you think the definition of alternatives has changed over time?
Absolutely. It has. I think, when I started my career, really that was mostly private equity. I mean, even private debt, we were trying to define whether that should be in a high yield pocket of capital, or it should be in the alternative pockets of capital when we're going out speaking to our investors. I think the market is now a lot more educated about what alternatives are. I think you have some very large asset managers that have really flourished in that environment I was describing before. It was really after the global financial crisis that there's been a number of opportunities in a number of these segments of the alternatives market. And besides private equity, which has always been the kind of booming market, and what most people have, one of the reasons why people have been calling it the golden era of credit, there's all these other markets that we're only starting to get into over the last 2, 3, 4 years. And These are sectors that historically, especially in Europe, the banks were heavily involved in. If you look at our US cousins, the majority of the market there is really financed through alternatives, through the private market. Over 80% of that of financing is really private. And if you look at Europe, when I started in the industry, it was nearly 100% financed by banks. And as the banks have been really focusing their efforts in in the M&A market and or really kind of moving at different assets, and there have been, shrinking some of the balance sheets. You have had alternative asset managers, raising capital to tackle those, opportunities in those sub-segments. So yeah, absolutely. I think the definition of alternatives has changed enormously, and I think even now we're continuously educating the market on what we see as alternatives, and specifically the investment grade bit is something that's very new. 5 years ago, like no one would have thought that you can do a private loan to an investment grade issuer. You just tap the market. So I think there is new technology that is constantly being introduced, and as I say, keeps the job fun.
Great. So if we can now go back to talking about you and your career, what would you offer in terms of advice to the young women who are interested in careers in investment today?
Um, So the first piece of advice I would offer is don't be put off by how few women are in our industry. It is changing. It is changing. When I started in the industry, there were very few women. It is changing. It's, you can argue it's changing slower than a lot of us would like to see it, but it's definitely changing. But what I would say is that we're so much more than our gender. I met a number of very impressive management teams, and there was a woman CEO who was always really frustrated because she was saying, look, most people describe me as the most successful woman CEO. And she's like, I want to be the most successful CEO. I don't want to be the most successful woman CEO. And it really made me think, that's absolutely right. You are so much more than your gender. Where you grew up defines you, where you studied defines you, where you're from defines you. And what we try to do is really build different diverse teams because we think that makes you a better investor. So I think it's absolutely an advantage having a slightly different point of view. And I think with that difference comes opportunity. For sure, there will be times that people will have some bias or prejudices, but you'll have to move on, prove them wrong, and then once you do that, you stand out a lot more. So the first piece of advice is don't be put off by the shape that our industry is in today. It's definitely improving, but it's not where a lot of us would like it to be. The second bit, the second advice I would give, which is kind of linked, is that you have to try and be your own person. Especially, on the topic of gender, as a successful woman in the alternatives industry, there's going to be people who tell you this is what you should be, this is what you should look like, this is what you should sound like, and there's going to be some bad advice that's out there. And what I have realized over time is that you don't have to act like that person and that person. You don't have to, try and imitate them. Actually, you kind of have to try and be your own person. And this is an amazing industry because there is no handbook of how to be an investor. You just learn through experience, and you have to shape it. You have to shape your own investment activity and acumen in your own way. And every single experience you're having in your perspective and the lens by which you look at things is very unique. So by being authentic, I think ultimately you are going to be more successful. You're going to be able to see things that others won't be. So instead of trying to change this, you should embrace this. And it has definitely taken me a long time to, figure this out. But I think it's one of the best pieces of advice I can give to people. And then the last bit is grit. You will need grit in this industry. People who know me will know I am a very competitive person. Uh, I like winning, like a lot of us, and you try and put your best foot forward to, try and team up with management teams, try and, do something that's different to your competition, to try and win a deal. But, and when you win, it is amazing. But there will be times that you will lose this deal, and it will be, it's a lot of times it will be like a crushing defeat, and it doesn't even have to be deal specific. It could be, something you really felt passionate about. You're pushing for something, and you're just not able to get it through. And you will need to have grit and determination to find the resilience to bounce back. And in this industry, the highs are very high and the lows are extreme. And it's what makes this job, I think, really exciting. It's never boring. I promise you that. It's definitely not boring. But I think once if you continue to feel that you're doing something you love, I think you can have a lot of fun. And maybe the last bit that I think is relevant for some of the young women who are trying to get into the industry is relationships. So I think that some of the young women I meet, maybe they feel less confident around some of their modeling skills, or maybe they're not, the best at mathematics, and they're saying, look, the job is all about like spreadsheets and modeling. And yes, you have to be able to understand maths and modeling, and you have to be able to identify patterns. But honestly, this is probably the most commoditized part of the job. And who knows how we can use AI to, automate some of that stuff on a going forward basis. I think the more senior you become in the industry, you realize it's actually all about relationships. It's about building relationships. And I have learned that people want to do business with people they like. And I think as a lot of women have a little bit of an advantage in that. I do think they tend to be more intuitive. I do think a lot of us can build relationships easier, and they're extroverted. So if you enjoy looking at a spreadsheet and doing a lot of the analysis, I think that's fantastic. But maybe like private equity and private debt might not be the best career, because ultimately the more senior you become through the ranks, relationships really become very important.
So my final question to you is, if you weren't in the investment world, what would you be doing?
So first of all, I'd say I like doing what I'm doing. People who know me know that I get bored very easily, and I like the fact that this job is not boring. So, for all the various reasons I explained. You probably take me back to a childhood dream, and that is to do professional sports. So I used to play tennis professionally when I was much younger, and I was on the tour, and I was I thought that was a really cool thing, and you're young and you think you can conquer the world, and that's a pretty awesome thing. I look at athletes as a spectator, and I'm at awe at what they are able to achieve. And again, grit, determination is unbelievably important. And actually, I take a lot of my motivation from that. Sometimes I'll be watching a match and I'm like, wow, like 2 sets down, they come back, they just reset. They're like, you fall down. You just have to get up and do it again. And learn from your mistakes. And then do it again. And then do it again. And I think that's the way you should be looking at anything you do.
There's a lot of parallels, actually, ironically, when you think about it.
Yeah, I think so too.
Look, Natalia, thank you so much for today. It's been wonderful to speak to you, and I'm sure there was a lot of wisdom there that we shared with all of our GAIN audience. If you'd like to find out more about alternative assets or indeed any sector of the investment management industry, we have a wealth of resources at gainuk.org, as well as a fortnightly student newsletter with details of all our events and programs. Thank you, Natalia, so much, and speak to you soon. Take
Thank you very
care.
much for having me.
Bye.